A simple way of looking at life is as a series of choices, where there's a probability that we may gain something and a probability that we may lose something. In economics, these choices are called prospects, and when people are presented with prospects, they display a behaviour called loss aversion. This means that people generally hate losing more than they enjoy winning. For example, Kahneman and Tversky did a study where they gave people a choice between an 80% chance of winning $4,000 or a 100% chance of winning $3,000. Mathematically, the first choice is better. The expected outcome is 80% times 4,000, which gives us $3,200. This is more than the expected outcome for the second option, which is $3,000. Almost everyone, however, chose the second option because they preferred the risk-free option of having a guaranteed $3,000. The experimenters then reversed this into a negative prospect. Now people had the choice between an 80% chance of losing $4,000 and a 100% chance of losing $3,000. Mathematically, if you now choose the first option, your expected outcome is to lose $3,200, which is worse than the second option where you're expected to only lose $3,000. So now people should choose the second option, but they didn't. Almost everyone chose the first option. They were happy to risk losing $4,000 for the small chance that they may lose nothing, because they couldn't stand the idea of just giving up $3,000. Kahneman and Tversky used this to model how people are likely to behave. When we're making a profit, we prefer to cash out instead of taking more risk. This is called risk aversion. But when we're making losses, because we hate the idea of losing, instead of minimizing our loss, we prefer to take even more risk and risk making an even bigger loss in the hope that we might make our money back. We become risk-seeking. Terence Odion showed that this is exactly what happens in the stock market. He looked at trading records between 1987 to 1993 and found that investors were very quick to sell winners, the stocks that were making a profit. But they held on for a long time to losers, the stocks that were making losses, in the hope that they would make back those losses. Odion found that the average returns the following year on the winners they sold were 3.5% more than on the losers they held on to. So in general, the winning stocks continued making more profits and the losing stocks continued making more losses. This is called the disposition effect, the behavior of the average investor to sell profitable stocks and hold on to loss-making ones, which makes him much worse off financially. This extends even wider, for example to gambling, where gamblers often end up losing thousands trying to recover an initial loss of only a few hundred. Gambling companies are aware of this and usually have offers that encourage people that lose to try again by giving them a free bet after they've lost. They know that once people start chasing their losses, they're not going to give up until they've lost a whole lot more. While we all often live under the impression that we're rational and sensible people, the truth is we're often not. And while loss aversion is there to help us avoid losses, it can accidentally end up driving us into even more losses. So we should always be carefully observing the choices that we're presented in life and be conscious of the many biases we have, such as loss aversion and the anchoring effect, which I've discussed in another video. Thanks for watching. Please like, comment and subscribe, and check out my other videos.